Good afternoon. My name is Ala McCoy. Very happy to welcome all of you to our workshop on Founders Equity, led by Manny Stockman, principal with Osage University Partners. Just a very brief introduction to Manny. Manny, thank you so much for joining us today. I know you're very busy, but this workshop is absolutely fantastic and very much needed for faculty and graduate students. It's a question that I hear a lot from them. So Manny joined Osage University Partners as a principal in 2015. At Osage, he has invested in core technology areas across software, computing, and hardware. He has held director or observer roles in startups such as EverCreative, NewMet, Sci5, and one of University of Maryland owned IonQ, which I'm sure you all have heard about. So prior to joining Osage, Manny was at Lockheed Martin ATL and Skunkworks as an engineer, executed on the transition of early stage technologies into the defense industry. He often joined university researchers with his industry team to develop unique technology solutions across the materials, applied physics, and photonic domains. Manny holds a PhD from Princeton University in aerospace engineering and applied physics, and a BSE in mechanical engineering from Duke University. So thank you so much, Manny, for joining us today. I will be monitoring the Q&A. Otherwise, I will mute myself and turn off my video. Why don't you go ahead and...
Yeah, sure. Thanks, everyone. Ala, thanks for the introduction. There's only one thing you left off, which is the least important, but I grew up in Maryland, and I grew up a Maryland Terrapin fan, and then I went to Duke, and so all my friends no longer talk to me. But I spent many years on that campus seeing my brother, and since we invested in IonQ, obviously coming down a lot more. The quick background on Osage is that we're investors in startups that spin out of universities. We've been doing this since 2009 and built a fund that works with tech transfer offices like Ala's to get the startups that faculty and grad students are spinning out on our radar for investment. And we share a portion of our fund's profit, which is also called carry in the venture world, back with the institution, that we hope will go towards driving more entrepreneurship and more startup opportunities for us as well. We are very excited to have been investors in IonQ, and it is startups like that, events like their public listing, which can really create a ton of momentum for an ecosystem. And so really looking forward to seeing how the quantum programs that are being established at Maryland and many others across the entrepreneurial ecosystem there can turn into new startups that we hope we can be helpful with. And so feel free to reach out to me whenever, either directly or through Ala. And we have both a life science team at OUP and a tech team. I'm obviously on the tech team, just given my background. But really, this is not meant to be about us. That was meant to give you context for what we're going to share with you, which is a whole bunch of information on some things to think about as you're building your startups out of University of Maryland, and go from there. So moving down a slide. This is me. I'm a deep tech person, although I think that was 6 years ago. So I do miss the lab and building stuff. But one of the reasons I enjoy being at Osage University Partners is because I just, very multidisciplinary, and I love seeing how research converts into technology and products. I was never a program of record like guy at the DoD world of Lockheed. I was definitely very much in the R&D side of things. So working with DARPA and universities to build new ideas for the corporation. So, this talk is really structured in a few ways. One is on founders equity, how to think of when you're starting your company, what are the right ways to distribute equity amongst the founders? And then also a few things to think about in terms of dilution and what that really means for your ultimate success. And success can mean many things. Obviously, just seeing your technology get to market is one of them, but let's not kid ourselves. It'd be unfortunate to see your technology get to market, but not have you all financially benefit as well. And so part of what I wanted to go through here was how the economics of starting a company and succeeding or failing in a company can play in your favor. I often like to think of things when I talk to entrepreneurs, like, are you going to have a life-changing event? And it's a really big incentive when you can think of building a company with co-founders and employees, because the upsides can be very large. And that's one of the most exciting things about being at a startup, whether or not you're a founder or an early employee. So a few terms and definitions. This is meant to be kind of a 101 type discussion. So I apologize for anyone that already knows all of this information, but I think it's just valuable to run through some of the basic pieces. And feel free to ask questions throughout. I'd love to answer things live, in sized 17-person size groups like this, where I'd be giving a talk on campus. I love these because everyone's just more interested in asking questions. And sometimes it does translate really well in a virtual world, because the Q&A is just so easy to type in, or feel free to raise your hand and Allah will pick you up if she allows that. So a few things. When you're building your company and you're thinking about equity and raising venture dollars, you are going to get a term sheet. And a term sheet has a few key terms. A term sheet from an investor that wants to give you money in exchange for a percentage of your company. And there's a few key things to look at when you receive that term sheet, and you need to understand them. This is meant to be a very quick way of showing it, but I actually recommend anyone who's going into venture or into a startup and fundraising out of a university reads a non-academic textbook on fundraising. It's called Venture Deals by Brad Feld. Just a great book, really lays it out simple. You can read it in a day, and it goes through a lot of these elements. But when, as a venture investor, I provide you a term sheet, they're just going down the list. There's something called a pre-money valuation. And this is what I think your company is worth today. When you combine that with the amount of capital I want to give you, let's say $5 million, and I give you a pre-money valuation of $10 million, I'm saying that everything you've built today, all the hard work and research and team building you've done is worth $10 million. I'm basically setting the percentage of your company that I'm going to buy. And the post-money valuation is not always equal to this, because there's things like creating option pools that you should be paying attention to. But the post-money is equal to the pre-money valuation, what your company was worth after or before we invested, plus the amount that we raised. So the 5 million that I put in is worth 5 million. So if you're worth 10 beforehand and I gave you 5, your post-money valuation is $15 million. When you hear or read things like fully diluted shares or fully diluted ownership, it's basically the total outstanding shares that exist, where generally as a venture investor, I'm buying something called preferred shares, which I'll jump into in a slide or two. And those are preferred. They're better, they're more valuable because of some of the terms around them. Whereas founders or anyone else on the early cap tables or people that have exercised options have common shares. And this is in contrast to a public company where everything is common, whether you've bought $100 million of Apple stock or $5,000 in your day trading life. It's all common shares. In a private startup, there are classes of shares that can have a variety of terms, and not even all the preferred shares necessarily have to have the same terms. So that's kind of the concept of fully diluted and preferred stock and common stock. So getting into the preferred stock side of things. So preferred stocks, as a reminder, it's what investors are buying. And I'd say, in a world that is not today, investors are often in a buyer's market. We have more flexibility to put terms in a term sheet that are beneficial to us. It's a seller's market right now. There's a ton of venture dollars out there, and all these terms are negotiable. But in a buyer's market where venture is in the catbird seat, there are lots of mechanisms that we use to reduce our risk or manage our risk in a completely fair way that any open market should really be doing. And I thought it'd be good just to highlight for you all what we pay attention to and what we think about when we're offering terms. So this is all around what's called the liquidation preference, which if it wasn't for this, the terms in your term sheets would be pretty straightforward. So I wanted to go through them. As I mentioned, preferred shares have, and common startups have different value than common shares. And it's because some of this liquidation preference exists. So for instance, I can put any one of these three categories into a term sheet for my preferred shares. And what it basically means, the first thing you should have in your head is that we're buying preferred shares, which means first capital in, first capital out. So I'm giving you $10 million or $5 million. If your company were to get acquired tomorrow, I would get my $5 million back. And then depending on which of these elements we agree on, the rest of that, whatever's remaining, may go to the founders or to the common shareholders, or it may get distributed to me, or I can choose to convert to a common share basis. I can choose many different options that benefit me. But when I'm writing you a term sheet, when we're making the investment finalized, only one of these can really apply. And the participating preferred is when I take my investment out first. And I also get to contribute or participate in the upside. So I get to participate in the front end pullout, and I also get to participate in whatever's left. And if it is the most favorable venture term you can get. There's also a multiple, so I can say I get 2x my money back first, and then I also get a portion of whatever's left. And I'll go through an example of this later. But that's the key thing to think about when you're taking on preferred shares or taking on investment, is investors will get their money back first. It's only a real issue if you get acquired for something on the order of what you've raised. So if you've raised $5 million and you get acquired for $7 million, investors take their first $5 million back. And then what happens with that $2 million that's remaining depends on some of these terms. Caps basically cap how much I can get back. And then, 1x non-participating preferred is actually the standard terminology that investors are offering today. And it basically is this scenario where I can either choose as an investor to get my $5 million back, or I can convert and just on a fully diluted basis, so that my return is is basically the same governing equation as yours. How much of the company do I own times the exit value? And it's not worth diving into here, but if you were, multiple years into a company and you'd raise $70 million and you get acquired for $150 million, what you'd soon realize, if you have participating preferred features in your agreements, is that there's actually a non-participating preferred agreement, is there's actually a zone of indifference, which is really interesting. It's basic math. It's interesting to look at because there are values of acquisition that investors don't care. It could be 120 million through 170 million and their returns will be the same. So it's just something to think about as you're understanding the terms of the deals that you're looking at. And, when it comes to raising capital, it's often, how do you figure out how much money to raise? You can, try and raise $1 million every couple months or you could raise $10 million over so that it lasts you 18 months or 2 years, or I'd say $100 million, so it'll last you 10 years. What you really want to be thinking about is this simple equation, which is your dilution. And your dilution is right now, if you haven't raised any money, you and your colleagues own 100% of the company. And when you take on venture capital, I'm buying a portion of your company. And that amount that I'm buying of your company is the dilution that you will face. It's the reduced ownership that you'll have after I own a portion of your company, or we own a portion of your company. And it's a simple equation. The dilution is the capital you've raised divided by the post-money valuation of the round. And when you think of the capital you need to raise, it's a function of what do you need to buy, how much do you need to pay your employees, and some kind of non-functional measure of time. And all those things go into you deciding how much should you raise to create the most value inflection. Because when I give you several $1 million, I don't want my $5 million to turn into $5 million. I want it to turn into 20. And the valuation that you can create at your next round is some function of the revenue that you've produced, the attractiveness and excitement around your product, the experience of your team, and the market you go after. These are all very qualitative, non-financial based judgments, but that valuation that you can generate at your next round or your current round and your next round governs your dilution. And so you could raise $1 million and go back to raise more a couple months later, but it's exhausting to raise capital. You could raise $200 million and have yourself set for 5 years, but the valuation you would get today is not necessarily what you would get in 18 months because you've had progress. And so you really want to optimize for that basic kind of understanding of get enough money in so you can show demonstrable progress and create a value inflection so that the next time you have to raise money, it's less dilutive. And so generally the rule of thumb in venture and startups is raise enough capital to last you 18 months, which is a great cadence to go back to the street for more dollars. So getting into forming your company, and this is a talk we've given, this is a portion of a talk we've given at a variety of campuses that we work with, because it's such an interesting problem. And how do you as a company, as a set of founders, decide how much each of you should own in the startup you're about to form? And there's a few things that are really interesting in university spinouts where oftentimes they're formed by faculty and their grad students and faculty peers. And especially in the kind of faculty and grad student postdoc relationship, it's a little bit asymmetric in the power structure, where you have faculty who have taken a risk on the student, put decades of research into the body of knowledge that will be licensed to the company. They've advised the researchers. In some cases, the students are still pursuing their degrees. And the graduate students are just excited about finding a job. They're passionate about the technology. And they have to negotiate with their advisor on something that's not related to their PhD. So it's a real conflict. And we created this talk because we'd heard from enough universities that there would just be great to have some benchmarks to go on and best rules, best practices. So when you're thinking of equity at any level for your co-founding team, for your early executive hires, for your early engineers, what you want to do is try and simplify how you think about things and look at it in this framework of you want to reward for past performance, reward for past contributions. Were they the seminal researcher in their field for decades? Were they the lead author on their paper? Did they drive the idea for this startup? Those are all things that are really important to think about and reward. But possibly more importantly, it's hard to put a real balance on this, but you want to incentivize future performance. Building a startup is as long of a slog and as difficult a journey as anything you all will deal with in the university world. And it's required that you learn things that you never would have learned if you stayed in the university space. So when you pause technology development, go after markets and commercial sales, you're going to be wearing lots of hats that you really need to have a team that can work towards and people that want to go after that. And so the simple way we think about it is reward for past performance and incentivize future performance. And so because this is such a difficult kind of thing to do, we also try and put some numbers on there just to get your minds around what should an initial equity structure look like. And in venture, we call this the cap table. It's a list of names or entities and how much each group owns. So, when you're forming the company, nothing exists. There should be no real investor cap table. It should be the founders and possibly an option pool. And an option pool is what equity you're going to pull out of to incentivize employees to join, because you're not going to be able to pay them enough salary. I'll get into that later. But the key message here is, there is nothing more important to your company than being able to hire a great CEO leader. And sometimes that person is worth a very large portion of your company to get them in early. It's not always necessarily a business person. It can be a technical person. It's not necessarily an MBA student. It can be a PhD student. But it's this kind of initial CEO who is living and breathing all the other non-technical things that your company is going to be doing, and drives the whole process forward from product ID to team development to fundraising, and is just full-time, full throttle. They don't always exist at the founding. And so this pie chart doesn't always apply, but we have found that in many of the companies that we've invested in, whether it's 2 founders or 5, that there generally tends to be one spokesperson. And so, it is good to see that that person is rewarded and incentivized for future performance, even if their past contributions have not been as significant. And then the kind of remaining 40% is meant to be distributed amongst co-founders, founding scientists, early VPs, VPs of product, some things like that. So to really put some, meat on the story, we wanted to try and understand what is the right balance. There's no one size fits all to companies, and we've invested in over 100 university spinouts out of our ecosystem. And we went through and looked at the cap tables of these companies at their founding to really see what was not the standard, but what was the mark of a company that we thought was investable. So this is not necessarily what every company should do. It's an example of the bias of our investment practices, which you can or cannot take as a good placeholder of what makes for a good structure for a university spin out. And so the thing to take away from this slide is we surveyed over 100 companies, looked at the founding cap tables, and tried to give you all an example of equity percentages that each of the kind of archetype personas was receiving when the company was founded. And it's difficult to do this because companies, as I mentioned, sometimes have 1 or 2 founders or 5 founders. And obviously you can't split up the pie the same way for all of them. But the general rule of thumb is something I'll jump into in a slide after this. But what I wanted to show you all was just there's a decent amount of data behind this that we think kind of is representative of a quality cap table. And the other message is every situation is different, right? So it really just depends. So when we did this analysis, a few things kind of came clear. And we just re-updated this because the talk was so well received, lots of questions, but it really just helped everyone to start thinking about it. And so we went deeper and just kind of wanted to point out some interesting tidbits. For one is that founders, whether they're professors or grad students, are really the ones that are thinking about joining full-time, taking 1 to 2 years off, or if they're a grad student, obviously it's their, it might be their next job. They're given asymmetric ownership over researchers and advisors and professors who may not have the ability or interest to join the company full-time. And so oftentimes there are a number of part-time PIs that join startups as founders, and they may be able to work 5, 10, 20% a week on this, but they can't do the 200% type effort. It's just not possible given that they're also balancing the jobs that they have at the institution. And so those are things that you should expect, is that in some ways that commitment, that incentivization of future performance is more heavily weighted than incentivizing past performance. When it comes down to it, investors are investing in the future and they respect the past, but it's really something that I think we look to more to make sure that people who are going to be driving the company forward are incentivized to do it. The other thing we noticed was that of the 63 founding CEOs who were previously a professor, of the 63 kind of founding CEOs that we kind of assessed, 10 of them were previously professors or graduate students, which was actually surprising for me to see. I often find that there's always a professor or a grad student really deeply involved. And sometimes we're investing in this Series A and we weren't there for the founding of the company, but we did figure all that out. And roughly around 16% of the opportunities we looked at, the startups we invested in, the CEO was the researcher. And it really goes to show that some of the companies that we invest in, not all companies, not all good companies, but the ones that we invest in have found a way to bring in a non-academic leader. And so that's something that we often find very, very relevant to a quality company. I'd also say that most often when the PI was the CEO, the graduate student was the CEO, it was a tech company. So 9 out of the 10 companies where that happened, 9 out of the 10 companies were tech companies. Life science is kind of a different beast. I'm happy to answer questions on or defer you to my colleagues, but those companies often end up being formed by venture funds and surrounded by high quality entrepreneurship out the gate. And that's just something that's a whole nother topic. I'd say there's also a variety of equity distributions amongst the sectors, and the universities often have a stake in these companies. And we found in the data that sometimes life science companies award the university more equity than in tech companies. Not always, but it's generally the case. And the other thing that we often got asked, because we expressly say, incentivize future performance, why shouldn't a faculty who has spent their life's work in this space, is preeminent in their field, will bring candidates and recruiting to the company and industry relationship, be rewarded more? And the answer is that oftentimes they do. If they're truly at the level of that caliber, there are many individuals in the founding teams who aren't full-time but still receive a asymmetric founder stake in that. So those are just a few things to think about. I kind of hit on this. I can already tell I'm running slow, so I'm going to cruise forward. But it's just really the takeaway is, even if you're not a full-time employee as a scientific founder at the company, there's a ton of value you can deliver, whether it's through the industry connections you bring to the startup for potential product development or technology superiority or recruiting that can continue to add value to the company, regardless of whether you will be receiving more equity in the company. You obviously want the value of the company to grow so that your equity position has more value at the end. So out of that graph we showed, where we kind of assessed around 100 companies, we also try to create some rules of thumb. And these are not meant to be rules. They're just meant to be rules of thumb. They're meant to be guidelines. And from this, in this upper category here, these are kind of some of the early line items on the cap table. We think the founding CEO, which isn't always a non-academic, it could really be a professor or a graduate student, should roughly own around 30% of the company. And when you have a few different founding PIs that are all pretty involved in the company, those are in the 10 to 40% range, depending on the number of founders that are involved. And this is kind of all in the mindset of, you also have to think about your options, that there's a 20% option pool here. This is the real take home, where part-time founders who aren't going to be working full-time at the company, maybe spending a couple hours a week or handling a phone call here or there, really should not typically expect to have an equal portion of the cap table. And so we've seen this number float around 5% across many of the companies we've invested in. And sometimes they get more, as I mentioned, but as I'll get into in a slide or two, if it's too big and we see someone that's on the cap table with a large ownership position and they're not contributing much to the company, we'll try and really get to the bottom of it and understand what they're contributing. And it's really hard to adjust for that. You can't really change equity after the fact, especially after you've raised, let's say, your first venture round. I'd say the universities are often between 5 or 15% equity ownership too. It's just part of how I think of universities, how I know a lot of the entrepreneurial ecosystem at Maryland does, and many other institutions, is they were the early, I think it was the early seed dollars into the faculty research programs. They have startup packages where they put at-risk capital well before any other investors did. And as University of Maryland and many other institutions build up these really large venture centers, it's helping the companies before they even realize they're asking for help. And so on top of that, there's just regulations around the IP that they generate, that you all generate, that they patent on their path to creating value out of that. And so generally, the industry norms are in this category for university ownership of around 5 to 15%. And we've seen all sorts of ranges, up to 50 every so often, when it's a huge effort by the university to develop a certain technology, all the way down to a couple percent. So I'll just, all these slides are shareable, and I won't go into the rest on this page, but let me know if you have questions.
So for the question, just to kind of reiterate, I think you explained it well, but just to reiterate, oftentimes when we have scientific co-founders, they tend to split when they start the company, they tend to want to split the equity equally, thinking that that's the fair way of doing that.
No.
Is that a good idea?
Yeah, no, it's not. This is a short message. I can't remember if it's in this deck or not, but it's the wrong way to do things. You really kind of, it's easy to be really excited when you're starting your company. You know, you'll think you'll be the next Google, and what does it matter if you have 5% now or 25% now versus, you know, I think those things can really affect a company in the long run if it's not clearly discussed at the beginning that everyone truly is going to contribute equally. And so it's really important to think out that in the very earliest days.
Yeah, thank you.
So Ali, you teed up the slide, which is, you know, the consequences of poor equity allocation. And, you know, let's just break it down. A parasitic founder is a little bit aggressive of a term, but, you know, it's really around like, once you give someone equity, it's really hard to scrape it back. So first off, work with a lawyer when you're starting the company, leverage the resources that Ali's team has to find a local lawyer that would probably do this on a very affordable term. You know, get a founder's equity agreement in place with things like vesting, because it's really important. You know, you don't want a founder to come in on day one, own 100% of their shares, and then a year later have some other life challenges or lack of commitment where they've decided to leave the company and they still own all their shares. There's classic terms called founders vesting schedules. And I really suggest you all do that, because the last thing you want is someone who was supposed to be with your company for the long run, not there, and you're working tirelessly and they're not, and they will generate the same upside that you will when the company sees its ultimate success. The other aspect of, you know, poor equity allocation is you lose equity that you could award other employees. And I think that's pretty straightforward, so I won't get into it too much, but, you know, the option pool that you need every day to hire someone is important, because it's what incentivizes them to join your company. And then on, you know, what do we really do if there is an event or a situation with poor equity allocation in a company that we're looking at? First off, I'd say, like, if it is a poor equity allocation, sometimes we just want to walk away. And because the last thing we want to do is create ill will with anyone just so we can take a multi-million-dollar risk on your company. And there's no easy way to remove a shareholder. It's very hard to do. And but when you do it, you do what's called a recapitalization. We bring the value of your company down to zero, so everyone's equity is worth nothing. And then we redistribute shares to the people that we believe should be a part of the equity cap table. And it's messy. And also there's, once you take in any new employees or investors who didn't notice the same problem, you're also going to be impacting their ownership. There's no way to really asymmetrically just bring someone owner of equity down to zero. So it just becomes a challenging situation. And, you know, it doesn't happen all that often, but it is a pretty easy reason to pass on a deal. The same thing applies to bad investors that sit on your cap table. So there are investors who maybe, you know, through their approach to deal making or you know, leveraging the inexperience of a team, can bring in terms on their investment which are not fair. And so some things to obviously look at are valuation. Did they just buy too much of your company for a dime? Or did they potentially put in terms that would limit your ability to raise another round? So for instance, I mentioned some of those participating preferred terms. If someone before me has put in terms that are, you know, 3x liquidation, participating preferred preference, I'm going to want that too. And then that creates this crazy stack that is something that you all would be difficult to raise money around. And so, you know, there are challenges just as much for investors who don't think about what's right for a company as there is for startups when they're building their founding teams. Just trying to look and see if there's anything, you know, the other part obviously is just the culture. You know, if your investor is someone that is helping you build the earliest aspects of your company and they're really involved, they can set the culture just as much as you can, just as much as you allow them to. And it's just something to think about. And and make sure you really know the investors you're working with. One thing I'm always surprised at and happy to hear is when a group that we're thinking of working with, a company that we want to invest in, says, hey, can you connect me to 3 or 4 of your other portfolio companies so I can get a sense of how you operate? And I totally think every startup should do that, because we do it on you. We're doing direct diligence by asking you for introductions to people you've worked with, and going behind your back and talking to some of the people that maybe we know through LinkedIn. So I really recommend you all get to know your potential investors. I'm seeing some
Yeah, we have,
Q&A.
we have some questions from Hammy about dilution, and specifically, Hammy is asking, universities may ask for undiluted equity. How often do you see that?
Yeah, so we see it often. It happens, the anti-dilution clauses that universities put into their licenses are in many of the ones that we see. And it's because you don't often know whether a startup's going to raise $20 million on a $200 million pre-money valuation, or $20 million on a $20 million valuation at their next round. And so they do like to bring in that anti-dilution clause every so often. And I think nowadays there's enough data out there where if for some reason you really don't like it, you should just have a conversation with the licensing office and say, hey, the industry has, we're a materials company operating in this B2B approach, and generally at the series or seed round, they raise $4 million on $12 million valuations, and that's the a general average for the dilution, and just work backwards from there. So really to have a discussion on what the university is looking for, and you can have a frank discussion with them about why you don't want it and ways to work around that. Hemi also asked about dilution on founders and dilution in general. I'm actually going to get into that if I have time in a couple slides, so I'll kick the can on that. This slide. So, dilution. So dilution, once again, is the dollars you're raising divided by the post-money valuation, or the dollars you're raising divided by pre-money plus round size. And so you're selling a portion of your company when you previously owned 100% of it. So just to get a framework of what you should expect in a classic venture-backed startup out of a university, this is probably stale data, but the average successful startup, these are companies that exit for and make people decent returns, have raised around $40 million across multiple rounds of venture dollars, and they'll exit for around $240 million. So this is just meant to be an example. It's one that I remember we created 4 or 5 years ago, and valuations have skyrocketed, exits have skyrocketed, and round sizes have skyrocketed, but the math is still the same. And so when you think of this, like this scenario that we've set across 4 venture rounds is one that describes raising $41 million. And when you raise your seed round, in this case, it's a $1 million raise on a $4 million pre, and the post money therefore is 5. And so an investor in this top green area, teal area, has bought 20% of your company, 1 divided by 5. That means what used to be 100%, one of the co-founders, the other co-founders in the option pool used to be 100%, is now crammed down to 80%. That's the dilution that you sense as a startup. So you've given up 20% of your company, and you raise again a $5 million round on a $10 million pre. Note there that your post-money valuation from the last round was 5, and your new pre-money valuation is 10. So you've created $5 million of value with $1 million raised. And so your investors in this situation are relatively happy. I mean, they would have loved for it to be a $50 million valuation, but that's not always realistic. But you've done more for it than just a 1-to-1. And in this raise, your investors are buying 5 divided by 15% of your company. And so both the previous investors and yourselves, the founders and anyone else, are diluted by the new owners of the company. So the reason why it's not 33 plus 20%, I really suggest everyone search online for cap tables and you'll be able to see how the math works out. The reason why it's not 33% plus 20% is because the 20% was diluted by 30% as well. And all that comes together that investors, generally speaking, now own 47% of this company. And the math goes forward. And by the end of it, investors own 68% of the company in this model, right? And the founders own around 12% of the company. In between, there are going to be option pool refreshes, which only further dilute the company. But what I think you should think about here in general when you look at these types of dilution analyses is how do you increase your percentage ownership? The way you increase your percentage ownership in a company over time is by doing the most with the dollars you raise to increase your valuation in subsequent rounds. And that's what we call value inflection. So when you talk to investors, we always look for entrepreneurs don't really speak in terms of value creating events. They can talk about events and milestones, but we're thinking of what is, as an investor, what's the value creating event that I'm going to see in this round that can create tons of value based on what I want to invest in the round. And that's helps everyone involved. And so really, I always suggest to entrepreneurs not to focus too much on what the ownership that you'll have at day zero is. It's really about contributing value to the company and increasing value creation throughout. I'll pause and look at the questions here. Could you talk, one of the questions from Josh is, could you talk about how to benchmark additional equity to give early employees who are reaching the end of their vesting schedule? Is it typical to offer shares to these employees via the employee pool? The answer is yes. So, these are the golden handcuffs. And if you don't reward employees as they approach the end of their vesting schedule, then they have no reason, not necessarily no reason, but their reason to stay is limited. And so options are the only way you can really keep the handcuffs going. And it's a great reason for employees to stay at companies, and it's how they can generate a ton of value for their own wealth. And so it's something that you should be thinking about. In terms of what's the industry standard, there's no industry standard. There's some benchmarks based on employee title and things like that. I'm not an expert in it, since we more see it happen at the board level, but there are kind of databases out there that if you are running a company, you can pay for access to or talk to some of your peer groups to understand. This kind of gets into Josh's question. So, oops, to the previous slide. So why are options important? It's because this is an incredibly competitive, more than ever in my time in venture, an incredibly competitive market to hire into. So you have the FANG companies, Facebook, Amazon, Netflix, Google, offering multi-$100,000 salaries to software developers, optical engineers. It's a wild time. And my colleague created this, and Google is generating a tremendous amount of revenue from their employees. And they are doing it off of something as simple as a search engine, and their salaries are through the roof. And I expect they're higher now, because this slide is probably from 2018, but several $100,000 salaries that they're paying mid-level employees. And there's just no way a startup can compete with that. And so your options are equity that your employees will have in the company, are the only way for you to compete. You're not going to pay to compete with the bigger corporations, but you can pay by giving them 0.1% of your company that may be worth $100,000 today, but in success, when you exit for $1 billion, could be worth $1 million, and that's significant. And so that's really the armor that you have in hiring that you should leverage. And that option pool is something that you'll have to refresh when you start. You're roughly a 20% option pool, and you hire 20 employees, give them 1% each, or 100 employees and give them 0.2% each. And that depletes. If you hire a CEO, you might give them 10 or 20% of your company. And so when that option pool depletes, you've got to replenish it. And when your employees leave, sometimes they take their options with them, and you lose that incentive that's kept them there. And then every time you raise money, that option pool also gets diluted, like you saw on the previous slide. And so you have to continue to think about the status of your option pool, and do you have enough in it to hire great talent. And going away message is just like, without a team, you're nothing. You really need to expect to take on dilution, because no startup that I've seen become a successful startup is a one-person show. It really is about building a team and hiring great talent. And that's something that I think is a message that one of my colleagues mentioned a long time ago, which is when you think about owning a company, a lot of academics have this mindset of, I'm going to be giving up too much control by selling a portion of my company, so I won't raise venture dollars. And sure, that's fine, but it's unlikely you will create multiple hundreds of millions of dollars of value without raising several tens of millions of dollars. It just has rarely ever happened. And so you, in selling portions of your company, you are giving up control, but you can either have a large piece of a small pie or a small piece of a big pie. And historically, a small piece of a big pie has generated the most personal wealth for those involved. I'd say that doesn't mean that venture is for everybody. There are great spinouts from universities that I've seen that have built really strong businesses on non-dilutive funding, DoD grants, and kind of moving up the ladder there. Sometimes because they don't want to give up control, but also because not every company is attractive to venture. And so there are still ways to build very strong companies without just raising venture dollars. I think there's probably not time to go into this. This is just, it's kind of a no-brainer when you're building a company, and it's just ways to think about how to reward and just a framework to think about who deserves the most options at the end of the year. These are also very specific. This is a very specific slide on types of options that you should be giving to your employees. And this is something we don't have time to get into. I'll see what I can do in 2 or 3 minutes. I think it is helpful to look at this slide, which is not too different from the previous bar chart I showed. It's a 2-round scenario where you've raised 2 rounds of venture. And the first round was a preferred 1x, which is very standard. You know, investors get their 1x back. But the Series A was something called a participating preferred. And ultimately, you know, investors at the end of the Series A own 50% of this company. And then they get acquired for $250 million on having raised only a $5 million round and a $15 million round. So only $20 million of venture has gone into your company, and you were acquired for $250 million. In general, that's a great outcome. And, you know, everyone's really happy there. It's a very simple math, you know, to do the exit. Investors are going to get 50% because they own 50%, so they get $125 million, and the rest is also similarly calculated based on your pro rata performance. In this scenario, things like participating preferred don't really come into play, just a little bit, but this is the easiest scenario. Now, where it gets complicated, where you have to go back and think about the terms that you're accepting on a deal, is a down case. So let's say your startup was not acquired for $250 million, it was acquired for $25 million. So in this scenario, despite you thinking, wow, $25 million, I've only raised 20, you know, I'm going to see something in exchange for this. It's, you know, if you just looked at it on an ownership basis, you'd say, oh, the investors own 50% of the company, they're going to get $12.5 million. That's not the case because they have participating preferred. If they got $12.5 million back on a $20 million investment, that would not be a great outcome for investors. We'd be disappointed. And so because of the preferred shares, the preference stack, investors would actually get their $20 million back first, and then the remainder would get split amongst the other owners of the company. And more specifically, this Series A, this participating preferred Series A, also participates in that remainder because they're participating. So that's why it's not just a straight $20 million, it's 21.7. So in this situation, you know, the founders are not really left with an exciting exit, nor are the people that own options. And so it's really just something to think about. That's a challenge, and it's in markets where venture controls more of the strings. It's like participating preferred can come into play with multiples, but in a situation that we're in now, you know, the startups do own a lot more of the leverage, and so, you know, make sure you're not accepting terms that don't seem to be market standard. That being said, you know, an investor making $21.7 million on a $20 million investment is not good. we're in this game to make 10x investments because we're also going to have many zeros. And so really in this situation, no one's happy, even though it feels a little asymmetrically advantaged to the investors in this case. And really what we should all be targeting is this scenario, the up case. Let's just create a ton of value and share the upside equally based on our ownership. I'm going to pause here. Oh no, this one I should talk about. So this is typically if you're forming your company on day 0 and you build it and you want to go raise dollars, your very first angel dollars, your very first seed investments are going to come usually in the form of a convertible note or what's called a safe note that's been popular for the last 5 or 10 years. And what these are, despite there being lots of talk about safe notes are better than convertible notes or vice versa, what these are is you're taking in a relatively small amount of money compared to what your company would normally be raising over time. So you might be raising a $2 million round, and eventually over your life, you're going to raise $50 to $100 million. And that $2 million that you're raising now is coming from some mix of, local angel investors, family and friends who aren't professional investors. They haven't looked at, a decade of similar companies to know how these things play out and how they should be valued. And so a convertible note or a safe round punts the decision on what's your company worth today. It punts the decision of your pre-money valuation. And it's effectively saying at the next round, we'll figure out how much my 2 million purchased of your company based on where that next stage of professional investors prices the company. And so it's a really simple and easy way to bring dollars into your company, but also provide some protection for those who have invested in your company. Debt is seen truly as debt, and those that invest in debt would be protected a little bit more than they would with safe rounds. But I've stopped trying to really pay attention to the differences. I just make sure the terms that I care about are in the notes or in the legal docs for each. Generally, convertible notes come with a little more control and more asks around maybe board seats and preference on liquidation and pro rata rights and things like that. Safe notes just move faster. They're a little bit easier, but you can still put in any term you want into a safe note. You can make them look like a convertible note. The thing I'd say I'd be wary of if you're raising safe notes is just try to get away from safe note stacking, where you have a safe note from one investor at a $10 million cap and a safe note from another investor on a $15 million cap that came in 2 weeks later. It just creates a mess, like a true mess. And so it's really clean to have one round that may occur over time, but one set of terms, even though you may be able to get preferential terms from other investors. And the two things to read about when you do your homework are the discounts and the cap. So the way you reward someone for taking a $2 million bet early is you're giving them a discount on the next round or a maximum conversion price. So that's the end of my talk. I just want to look at the Q&A and see if there's anyone that wants to ask questions in the last couple minutes.
Yeah, thank you so much, Manny. This has been fantastic, and lots of questions or lots of material that you went over are a lot of the questions that I get a lot from our academic co-founders and people who work with them as well.
Yep. You want me just to fire away at some of the questions, or does anyone want to ask a question live? I'm happy to do that too. What's your preference, Ala?
So we have a few questions here in the queue.
Okay.
If anybody wants to raise their hand, I can unmute your mic and you can ask it live, but we can see Josh is.
Let me push through. So someone asked, do universities get board seats? Every so often it does happen. And it's usually when there's like a really knowledgeable group at the university that's been a part of helping the company move forward and can help with things like investor intros and customer intros. And it's helpful for them because they're monitoring some of their opportunities. I'd say we often like to see it is those board seats roll off over time. And so sometimes they have language where they'll relinquish the board seat after the first $10 million raised, or after the first formal venture round. Another one is there a difference between life science cap tables and physical science cap tables? I think generally on physical science cap tables, the founders own a decent bit more. but not always. It's really around the valuation at the earliest days. So a lot of life science valuations historically were low. And so venture investors who invested in the seed round sometimes own up to 66, like 66% of the company. And it's almost the inverse on the tech side, where it seems to be this like constant mantra of you're buying 33% of the company as an investor. Now it's going to be 25%, 20%. And so the early stage valuations on the tech side are just growing until the recent kind of bubble for IPOs for life sciences. Similarly, life science valuations are growing, but they're still comparatively lower. Are there any sources of valuation benchmarks by industry? There's a ton of information out there, and I don't know if University of Maryland's office has access to PitchBook, but there's a lot of great sector reports on valuation by industry, by stage. So the answer is yes.
Yeah, we only have access to Crunchbase.
Okay. Well, let me know. I'm happy to work with your team to get you what you're interested in.
Thank you.
Another question is, how does Osage look at previous grant money raised in the context of valuation? You know, this often happens where faculty and researchers say, hey, I've raised $30 million of DoD grants in my lab. And, you know, that has to be worth a lot, like more than 30 million. And it's really hard to put a value on that. What we really, you know, do is look at the status of the technology and what they've built and how close they are to productization. That's what really matters the most, not how much they've raised in non-dilutive dollars. And so it's great to see that they're able to do that. I often look for whether it's SBIR dollars, STTR SBIR dollars versus like straight grants or real kind of like next level type non-dilutive efforts with the DoD or NSF or NIH. But it's, you know, good to see, but it's most of the companies I've invested in, it's not a differentiator in our valuation process. I think that's it for the Q&A, and I think our time is up.
Yeah, just exactly on the tee.
Yeah, all right.
Thank you. So
thanks everyone for the chance to chat. You know, hopefully one day I'll be able to get back down there in person.
That would be great. That would be fantastic. Yes. So thank you so much, Manny. This has been extremely informative. We will share the video with the link to the video with you. And Manny, could we also share the slides?
Yeah, I'll send them over your way.
Perfect. So thank you so much to everybody who attended. Thank you for the great questions. And thank you so much, Manny. It's great, always great. And it's always good to have a video of this to refer RPIs who have questions about this. So thank you.
Thank you.
Okay, bye.